Hi, and welcome to the March Buy-to-Let Mortgage Market Update. My name is Richard Purnell. We're from the Mortgage Home, and we are your buy-to-let mortgage specialists. First thing I've got to say is thank you so much to everyone that got in touch to say, have I missed the February mortgage update? Okay, confession time. No, you haven't. That was me. I didn't do one. Why, you ask? Well, really good reasons, which I'll actually expand on a little bit more today, in that finally landlords felt that they had the confidence to come back and make decisions over either buying or refinancing during February. So all that business that we would normally have done in October, November, December, where it was so chaotic and for really understandable reasons, you guys didn't feel confident to make the decisions, and now come back during February to do that. So we were absolutely inundated with business, and so something had to give. So apologies about that, but normal service has resumed. So in this piece, I want to talk about interest rates. It's my usual headline slide. What's going on in the market? What's going on with the Bank of England interest rates? And more importantly, what's going on with mortgage rates? So let's do just a really brief recap. So we've got, at the time of recording this, so we're on the 16th of March when I'm doing this, and Bank of England rate is at 4%. It's the 10th successive rise, can you believe, in interest rates now to bring us up to that sort of 4%. And what's going to happen? Well, Andrew Bailey, who's the head honcho down at the Bank of England, is saying, well, the jury's out whether rates might go up again in March. Now, I think it's a bit of a moot point, because if they go up in March, and I think if it does, it'll be 0.25%, or it goes up in April, okay, they're going up. Still is the trend that there's still a little bit further to go. And I still see, I said it earlier on previous updates, that there's likely to be probably 2 more 0.25% rises this year. Now, this is all predicated on what happens to inflation. Again, if you're saying, well, why are we talking about inflation? We're talking about interest rates. Go back to my January update. I expand really on why there's such a direct link between the Bank of England interest rate and inflation. So we need to understand what's going on with inflation. We know it's been really high. It's been up at 11.1%. The good news is, over the first 2 months of this year, it has started to drop. It's now down at 10.1%. Okay, we've a long way to go. We know energy costs are still hurting. We know those bills are still high. We had the budget yesterday, having to put yet more measures in place to help us right now. And so I think they've extended it for 3 months, haven't they, the support with energy. Interesting that it is just short-term support, because I think all the great and the good feel that the energy costs are really going to tumble during 2023. And that is the main driver for inflation being up over at 10%. So the Bank of England are saying that by the end of the year, let's say another 12 months, inflation will be right down from where it is now, 10.1, down to 3%. And that the reason I'm highlighting that is that the Bank of England are using interest rates also to try and curb inflation. So that's why there's a little way more to go before they can start to see that inflation rate tumble. Then I think they can pause on pushing interest rates up any further. Now, to be honest, I don't think that's too important for us in terms of the Bank of England rate, unless you're on a tracker rate, unless you're on a variable rate. Then, of course, you've got this direct link to the Bank of England, and your mortgage payments are going up every time the Bank of England blink and put rates up themselves. But that's not the majority of us. And I'm talking really to our sort of portfolio landlords who get their mortgages not from the high street banks, but from secondary lenders. And because of the way these secondary lenders get their wholesale money to ultimately package up and lend to us as mortgages, these guys are far more interested in something called swap rates. Now, again, back in January, I expanded a little bit more about what on earth are swap rates, but suffice to say, these rates are far more important in terms of their trend, whether they're going up or down, far more important to the secondary lender market than the Bank of England rate. And that's why I keep referring to swap rates. And what's been happening with swap rates in the last 3 months, so we've got the Bank of England rate going up, swap rates have continued to come down. So that's really fantastic news for us portfolio landlords, because that means mortgage rates have continued to come down, because the savings that the lenders can make as swap rates drop down, because that's how mortgages are priced in terms of how much they pay at a wholesale level. So they can pass on those savings to us. And that has continued. I did mention that it was starting in January, and that has continued in January, continued in Feb. And it's starting to level out now in March. And as I've said here, the 5-year fixed rates in particular have continued to drop, and that's been the really sort of good news. When it comes to 2-year fixed deals, that's a little bit more uncertain as to what's going on, because it's harder for the financial markets to really try and predict what's happening over the next 2 years. So there's still levels of uncertainty, which means the 2-year fix are still, generally speaking, not always, but generally speaking, are being priced slightly higher than the 5-year deals. So 5-year deals really, really good now. They're more or less, I think, in my personal view, that they've bottomed out. We might have a smidge to go. But I think we're pretty much there, which is why I've been seeing landlords now coming back and making those decisions to move forward. So here's the thing. If you have been thinking about refinancing, if you're coming to the end of your existing deal in the next 6 months, so right up to September time, now's the time to get off the fence. Start an application today to lock in that new deal. There's no downside to starting it now. But you say, oh, but what if rates drop another 0.25% in the next 1 or 2 months? Won't I miss the boat? No, you won't, because lenders are saying, look, you can start your application, get it locked in, even get a mortgage offer out on the rate today. And let's say then the rates drop a little bit further in the next month or two. Well, then we just swap the rates. The lenders allow us to put that one in the bin and jump to that slightly lower rate that lender's offering. So you can't miss out. But the good news is you've got certainty, you've got that deal locked in, because who knows what's going to happen? We only have to go back 6 months. We don't have to go back far in history to know that surprises happen. Things come out of the left field, as it did in September when Liz Truss came in and brought that new mini budget out, and all of a sudden interest rates started climbing and going through the roof, and it caught us all by surprise. So we don't want surprises. So get your mortgage in now, get it locked in. You've got that certainty, and if rates start to drop a little bit further, then as your broker, we can then jump onto that lower rate. If you want to discuss any aspects of what I've talked about there about refinancing, getting slightly lower rates, then there'll be a link to our online diary. Just book in, speak to the team. There's no commitment, no cost, and we're more than happy to give you our advice. In this piece, I want to focus on holiday lets. So we've got a growing number of our landlords that have been moving more towards holiday lets. And within that category, within that description, I do mean service accommodation as well. It's a more cash flow rich strategy. So we get why landlords are starting to repurpose some of their existing portfolio and do that. So I thought this month we'll focus in on what are the sort of better, cheaper holiday let rates that are out there right now. So literally yesterday I checked, and these rates are still available, but when they're gone, they're gone. So let's focus in on what's happening here with this particular lender. So the first thing I want to say is that these are variable rates only that you can get. Now, if you love that comfort blanket of a fixed rate, if you want that certainty of knowing what the rate is going to be, what your payment's going to be, so from a budgeting point of view, then this ain't for you. But if you've got more of a tolerance to risk, then maybe a variable rate mortgage isn't too bad. And particularly what I've said previously about interest rates pretty much sort of peaking out right now, then actually it's a really good time to consider a variable rate mortgage. So the rate, 5.15%. For holiday let rates, that's a really good rate on its own. Now, the usual thing I do find with holiday let mortgages, not just holiday lets, but there's a few buy-to-let lenders doing the same, is the sting is in the product fee, or the arrangement fee as it's sometimes known. And it's not unusual to be charged by a lender 2%, or even 3% arrangement fee on your borrowing. So I know I've said here there's a minimum loan of 200 grand, but let's give an example. You've got a £300,000 mortgage that you want. And if that was a typical 3% arrangement fee, then you've got a £9,000 additional cost to swallow. Yeah, ouch, exactly. So it's balancing, looking at the rates and looking at the associated fees, usually the product or arrangement fee, to decide whether that particular mortgage is good value for money. So in this case, not only have we got a rate of just over 5%, but as you can see on this bullet point, the arrangement fee here is 0.3%. So instead of a £9,000 arrangement fee, it's a £900 arrangement fee. And all of a sudden, that's a little bit more palatable. So great combination in terms of rate and fee, which is why I wanted to focus on it today. As I said, there's a few caveats, so you might want to be jotting some notes down as I just go through these highlights. Minimum loan, £200,000. That's quite a bit higher than lots of other lenders in the market. So look, many of my landlords are buying larger holiday lets, and therefore a 200 grand loan is absolutely fine. It's not a restriction, not an issue. But if you're buying a 1, 2, 3 bed holiday let, or if you're buying a service accommodation property, which traditionally tend to be these slightly smaller properties, then are you going to meet that minimum 200k lending? Typically, alongside other buy-to-let products, we've got a 75% loan to value. Interest only, if that's what you want, which again, most landlords will go for. So it sits alongside the typical other sort of buy-to-let sort of parameters. Interestingly now, on this one, no minimum income. This is earned income. Now, there's a really growing trend towards this. More and more lenders over the last few years have started to do away with the requirement that the applicant has to earn a certain amount of income. It's really arbitrary. It has no bearing on what you're borrowing anyway. So it's a bizarre, blunt instrument, in my opinion. So I'm really pleased that more lenders are going away from that and focusing more on, as it should be, what rent, or in this case, holiday lets, what revenue is it going to bring in, and will that be enough to service the debt? So the only thing I would say, even though we're saying no minimum income requirement, that you don't have to meet a certain target, here's the thing about these things, is that the underwriters will still say, yeah, we may not have a minimum income. However, we want to know that whatever income you are earning as an individual, not the rental, what you're putting into your own pocket, is that enough to cover your own lifestyle expenses? Is that enough to cover your own unsecured debts if you've got any? So as long as the underwriter can see that whatever income you're pulling out is enough to cover your own outgoings, so you are self-financing, box ticked, they can focus then on the subject property and the rental and so forth. So yeah, I like that move towards this. Another really good attribute with this type of product is that this lender will also offer it not only on a personal basis, but if you want to put it in your SPV, in your limited company, yeah, absolutely no problem. Same rates as well. I do still see some differential with mortgage product rates if you're buying a property in an SPV compared to in personal. It's been moving more towards the same rates for a while, and quite a few lenders have adopted that. But in this example, we just have the one rate. So nice and easy. We know where we stand. Last point on here, there's a 3-year tie-in. So, there's a little bit of a commitment. But 3 years, for me, I don't think that's too horrendous at all. So you got to know it. You're not flipping it. You're not, you're going to be committing to that for the next sort of 3 years at least. Then absolutely, this is something that may well be of interest to you. So if there's anything within this piece that you want to discuss a little further, whether it's on this particular product or just chatting about holiday let mortgages a little bit more, would this suit you? Is it appropriate? Would you be eligible? Then at the end of this piece, there will be a link to our online diary. cut and paste it or click the link and set yourself up sometime, speak to the team, and we will be delighted to help. In this piece, I want to focus today on something called a refurbishment buy-to-let. It's not new. They've been around for a number of years, but they've been ebbing and flowing. And I've just seen actually this week, one particular lender that offers this type of product has just refreshed it, revamped it, updated the rules. So I thought, actually, yeah, this could really appeal to quite a number of our landlords. So who does it appeal to? How does it work? Well, it's really suited to you guys who are wanting to buy a property that is not lettable at the point of purchase. Hopefully, you understand what that means, but let me just explain for those that don't. That means at the point that you get the keys to the property that you're buying it, if at that point you would have to do some significant work to get it lettable. I don't mean cosmetics. I don't mean a bit of painting or maybe a change of carpets. I'm talking about maybe the kitchen isn't even there, or the bathroom it doesn't even function, or maybe there's a hole in the roof. It's something significant that says you just can't let it without doing some work to it. Well, that's a non-lettable property. So you're not going to get the traditional buy-to-let mortgage. So you have to look to bridging traditionally. Now, the thing about this refurbishment buy-to-let is that it's, even though it's what I call a two-step strategy, it's a two-step approach. There's going to be bridging for the purchase, and then when you've done the work, you're going to exit into a longer-term buy-to-let mortgage. But the real appealing thing about this is that it's all under one roof. It's one application. It's one lender. It's one underwriter. It's one surveyor who's going to go out and value it as it is, as you're purchasing it. You're going to give that valuer a schedule of works to say, right, this is what I intend to do to it to add value, to improve it. And then you're also going to say, and this is what I think it's going to be worth afterwards. So you're going to buy it for 100 grand. You're going to do 20 grand's worth of work to it. And you think, right, it's going to be worth 150. You've done your homework. Well, you give all that information to the lender, and that valuer will hopefully agree with you. So that valuer comes to the house, says, yep, okay, you're buying it for 100. Yeah, I think it's worth 100. I can see you putting 20 grand's worth of work in it. And yeah, I can see that that would give a market value post refurb of 150. So if they agree with your numbers, the lender will issue two mortgage offers simultaneously. So you have the mortgage offer on the bridging part, so you know you can purchase it. And at the same time, you've got a second mortgage offer so that when the work's done, you know you can exit onto a long-term bridge. So now, as a landlord, you've got complete certainty and all your ducks lined up throughout the whole process. And that's peace of mind, of course, for everyone. So some key points: bridging. The interest is rolled up. If you don't understand what that means, it means you're not servicing the debt once you've got the bridging. You are not paying a monthly payment. So right now, once you've got the property and it's got a hole in the roof, it needs a new kitchen fitting, you've got no rent coming in. So you don't want to be paying any mortgage payments. So the lender says, I get that. So let's just park those payments, put them to one side. And when you pay us back the capital, we'll also say, but you've had this bridging finance for 6 months. So the interest payments for 6 months equates to 3,000 quid. You borrowed 75,000. So you need to pay us back 75 grand plus the 3,000. Maybe there's an arrangement fee, usually is. So then you pay that as a lump sum back at that point when you're exiting onto your long-term mortgage. So cash flow, brilliant. Rates, really good, starting at 0.55% per month. Again, for those of you who are not used to that, what 0.55, what does that mean? Well, if you converted that to an annual interest rate, you'd probably be saying, well, it's about a 7% interest rate. And you might go, oh, that's a little bit high. Well, first of all, it's bridging. It is a slightly higher risk. But the second thing is, you ain't going to have it for a year. As you can see on my next to last bullet point, it's up to 6 months. So you're going to be paying it off in maybe 2 months, maybe 3 months, maybe 4 months. So you're not paying 7% for a whole year. You're paying it for a fraction of the year. And as it says here, you can borrow up to 75% loan to value. So that's the bridging part. Once that's all done, then you're going to be exiting out the bridging and moving it onto a long-term mortgage. And as it says here, rates are starting from 5.59. Not too bad, sort of middle of the road. You can possibly get lower rates, but not when you're coming from a property that's non-lettable. It gets really sort of messy. But here's the thing, you can get up to 80% loan to value. So what many landlords like to do when they get in these properties that you're going to be adding value to is, can I ultimately pull all my money back out? So the cash that I put in for the deposit, the cash that I put in for the refurb, once I've added the value, if I can then pull all that money out, and if I can potentially get an 80% loan to value on that higher value, there's a really, really good chance that you can get all of your money back out. So it ultimately becomes a no money down deal. And how many of those do you want to do? Probably as many as you can get your hands on. Couple of caveats here. These are suitable for buy-to-lets and HMOs. So if you're thinking, oh, my SA, my holiday let mortgage, would that be suitable? Not on this particular product. Look, you can still buy non-lettable products with non-lettable holiday lets, but we have to split this two-step strategy across two separate lenders. So yes, you can still do it, but it's a little bit more involved because you're not dealing with one lender. So today it's just about you buy-to-let guys, you HMO guys. And as I said at the start, it's the convenience is that everything is done at the same time. There's consistency in terms of the same valuer who understands exactly what you're doing, same underwriter. And so it tends to be a lot smoother. If any of that resonated with you guys, if it's something that you think, yeah, actually, I'm thinking of buying a property that I know is not going to be lettable, or even if you're unsure, is it lettable, is it not, then maybe we can help. We've got a lot of expertise in-house to maybe look at the photographs, the pictures, send us a link. We're not surveyors, so you've got to bear that in mind, but it might be we'll be able to say, yeah, that's definitely not lettable, and we need to go down this particular avenue. So there'll be a link at the end of this piece to our diary. Click on there, cut and paste, jump on, have a word with the team, and we'd be delighted to help you in this regard. In this piece, I want to talk about something really exciting. This could be game-changing, but it is early days. So please, let's not get too carried away about this, what I'm about to discuss about investor finance, but it is hopefully an exciting change in terms of how we can finance deposits for our buy-to-let. And by buy-to-let, I mean any investor type property purchasers. Historically, it's been really difficult, complicated to bring in third-party investor finance to fund the deposit on a purchase. It comes with a lot of hoops. Usually, you've either got to buy that property for cash with your investor money, which is fine if they've got enough cash to buy the whole thing outright. But if they've only got the funds to cover the deposit and you still need a mortgage at the point of purchase, then there are some options. And one of them being that you might want the investor to be a minority shareholder. It would have to be in an SPV. And there are certain other requirements or the policy rules that you got to meet. That aside, it's really sort of complicated. So what we're trialing is a situation where the lenders, with certain supporting documentation, will now allow a non-family member, not related individual to put the deposit in for the purchase. We're road testing it right now on a bridging purchase, and it's already been signed off by the underwriter. There's a couple of things at the legal stage that have to be signed off, but it's looking extremely positive that we're being allowed to use third-party investor finance to purchase a property. I've got to say again, right now, the scenario we're using is with a bridging lender, but it's the same rules. Bridging finance come under the same rules for money laundering and for what's allowable with where the source of cash deposits are coming from as a buy-to-let lender. So that's why I'm excited about this, and I'm quietly confident that this should work. So we're testing it on the bridging. We'll be testing it hopefully in April on a buy-to-let purchase, and I'll be able to give you more feedback. So really tune into our April update. I will give you more feedback how that bridging's gone, if that's gone through, and hopefully we'll be in a position to have a guinea pig who we can use on the buy-to-let side. If that comes off, that's really going to open the doors for you guys that are really wanting to use joint ventures and collaborations to push your portfolio forward. So exciting time. Really hope this is a game changer for you guys. But for now, that's where we are, and I'll update you further in April. If you want to discuss this with the team a little bit more, there'll be a link at the end of this piece to our diary system. Get yourself booked on there, speak to the team to understand it a little bit more, see whether you'd be suited to it. Do you qualify? And is it something you want to, maybe you want to be a guinea pig, maybe you want to be part of this experiment, because it really could open doors for many landlords to build their portfolio at a quicker pace. In this piece, I want to talk about life insurance in context to portfolio landlords. I know it's a cheery subject, bear with me because it's serious, it's important, isn't it? So I want to focus on those guys who are particularly wanting to build their portfolios up right now. We're on a bit of a journey to get to a certain level of financial independence. And once you get there, it comes with some fantastic benefits, not least the fact that it has an inbuilt insurance policy, because by definition, it's passive income. Whatever happens to you, whether you're working or not working, whether you're well, ill, or whatever, that income stream is going to come in. So it is an insurance policy in itself. However, what about for those landlords that are on their journey? You haven't got to that level yet. You haven't got to that financial independence target. You're on your way, and you've put a significant amount of time, effort, sweat into getting to where you are. So for me, it's the journey that you want to protect yourself on, because if something comes happen left field, and it does do, it happens, and sideswipes you and takes you really off kilter, where you can no longer continue achieving that particular life, that particular goal that you want to get to, then you could find that that dream is in tatters, or it's only partly completed. You've only got a fraction of the income that you wanted to get to, and now all of a sudden, because something really hideous has happened, you're no longer able to continue. So those dreams are now by the wayside. So why wouldn't you protect yourself and your family whilst you're on the journey, so that if that really hideous thing does happen, the insurance policy kicks in, clears the buy-to-let mortgages, and yes, you haven't got the volume of properties that you wanted, but you don't need them anymore because you're mortgage free. So you're going to retain almost all of the profit from rentals or short-term letting, whatever it is, within that portfolio, to accelerate the income to the level that you and your family now need in this really perhaps a desperate financial situation. So something I really want to challenge you landlords that are looking to build your portfolios, but you're not there yet. This is the time that you're vulnerable. And so if you really want to guarantee your success, then perhaps a little bit more of an investment in a few insurance policies, which can be as cheap as chips. If you're reasonably fit and healthy now, we're seeing you can get £100,000 of life cover for about £5 or £6 a month. I mean, that's just an extra large cappuccino. So it can be extremely cost effective to put the right policies in place to mitigate those really serious things that can absolutely derail your property plans. So if these are really important to you, and they do absolutely tend to be front and center goals for you and your family, then I really urge you to consider looking at putting some form of life insurance in place. If that is something that does resonate with you, maybe you've got some life insurance already and thinking, well, is it enough? Is it appropriate? Then there'll be a link after this piece to our diary. Click on there, cut and paste, whatever, jump on, book a time in with our insurance experts. Look, we don't make any charges for advice, so have a chat. We'll give you our impartial feedback as to whether you need a little bit more. Maybe you've got too much. Maybe we can actually cut back and actually reduce premiums. We can do a full review of your policies. So again, no downside other than putting a little bit of time in to make sure that that is reviewed and that these policies are appropriate. This is our last slide, more or less, that has links to our diary. As you can see, if you want to either take a picture, cut and paste into our online diary system, you can then book some time in as you wish. It's a 30 minutes consultation. We've got daytime, we've got evening appointments. So hopefully there's something that's convenient for you. If it's something that's really, really urgent, for example, you've had an offer accepted on a property and you read an urgent appointment and you've looked on the diary and you can't get in for a few weeks, ring the office number 01756 699 600. We will do our absolute utmost to fit you in so that you don't miss out on that property. Perhaps you're looking to refinance because you're coming to the end of your deal, you're about to go on to SVR, maybe it was a bit of an oversight, there's a bit of an urgency, and again, you want see, have we got a cancellation? Can we fit in a little bit quicker? Ring the office number and we'll see what we can do. Finally, this is just a snapshot of the services that we do offer. Frankly, it's anything that's secured against bricks and mortar, bridging, flip, semi-commercial as well as commercial stuff, development finance. Holiday lets, I include service accommodation under that umbrella heading, auction purchases. And right at the top, life assurance, income protection, critical illness cover. We're independent advisors in that area as well. So if you think we can help or you just want some guidance, direction, advice, then use the link I just mentioned and we'd be happy to help.